Hey, everybody. So thank you for being on. We'll have a bunch of people coming through. These are our What's Moving Markets calls. And this one's especially going to be fun because we're going to talk all about the US dollar. So you're going to learn all the benefits and drawbacks that come with the United States dollar being the reserve currency of the world. Itai's stuff that he put together is unbelievable. It requires mental effort. So if you need 3 to 5 minutes to get your head in a good place, like now's the time, get it. It's going to be a lot to digest, but it will be worth it. I promise you. Anyways, I want to start with how we normally do things, which is just a little bit of warm-up exercise. It's a warm-up exercise because we want everybody here to be interactive. It's no fun if you guys are just all hanging out in the background, doing whatever. We want your participation. So let's start with a question for today. If all of you had to guess what was the intraday high for GameStop, I want you to put it on the chat right now, okay? The intraday high for GameStop. So anybody that's been following what's been happening for this stock in the day, we want to hear it, okay? And Itai, you know the answer to this one, right?
Do I?
Let's see. I think I got it. Give me a second. All right, we're gonna give it just another. Minute or so. I don't even think a minute. We'll give it 15, 14, 13, 12, 11, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Okay, so the closest, I think I saw it go to about 145. So Tori, you had a 130 guess.
It actually went to an intraday high of 159 and 18 cents.
It went to one.
I just randomly guessed. I actually had no idea.
Okay. See, this is why you have Itai making sure that all the numbers are correct.
Yeah.
Okay.
Also a good way to let people trickle in.
It's a great way to let people trickle in. So we're going to learn exactly why GameStop went absolutely bonkers today, and that'll be kind of the first part of the call. And then the second part of the call will be about the US dollar. So I basically just want to introduce us real quick. Itai, if you want to share your screen, you can do it. And I'll give everybody the quick heads up about what Equilibrium is as you're loading it. But basically, everybody, we are Equilibrium Ventures. The three of us on the call right now, we have a fourth partner, but it's basically me. It's Itai. Tori, you want to wave and say hello? Okay, great. I'm in a gallery view. I can't even see you, but I'm assuming that you said hello back. We are basically the family office for everybody. So you'll hear us talk about uncorrelated strategies into the private markets. We're basically building a tech interface that allows anybody to quickly get onboarded and get a diverse basket of private market investments with low correlation to the market. So we think it's really cool. We're building the tech right now. If you're interested, you want to learn more about it, you can ping any one of us. In the meantime, Itai is kind of the king of this little Zoom course, so he'll be there. I'll have a chat going. Anybody that wants to ask any questions can just ping me here. And we want this to be interactive. So as you have questions, don't hesitate to ask them. Are we all feeling good? Can I just get some positivity, some thumbs up if you're feeling it? Oh yeah, there we go. Joe, I saw that. You were rocking out. Alex, my man, you got the smile going. Okay, Itai, this is going to be awesome. I'm ready for it. Go.
Thanks so much for the intro. Dive right into it. So I wanted to start talking a little bit about valuations. We heard a lot of chatter about valuations being extended. The retail traders back. We touched a little bit about that in the last call. So just wanted to do a quick check-in of where we are in the markets. S&P versus forward PE here in red, fairly elevated. S&P versus forward earnings, so price index here in red, forward earnings here in blue. We can see that market price is significantly higher than where you would expect given its correlation to forward earnings. It's actually not exceeding the February top, but nonetheless, price continues on, and it can do that for a long period of time.
And Itai, why would you have expected it to be more in line with where the February top was?
Well, just because forward earnings expectations have not yet exceeded the February top of 2020, but price has. But nonetheless, you know, I just wanted to tell people that can be the way for a long time. You know, between 96 all the way until 2000, the market was definitely exceeding forward earnings as well. So that's something that can last a long time. Let's look at quick price to sales ratio. It's actually at a new all-time high. The market has never been more expensive when you're looking at price over sales. And the famous Warren Buffett indicator, let's take the US equity market cap, if you exclude all the foreign issues, and divide it by the nominal GNP, and it's a 2.2x. So it's 2.2 times, I'm sorry, the size of the GDP.
And Itai, just for everybody that's watching, Buffett, can you just kind of scroll on with your cursor, where does Buffett normally like to buy?
So he made famous that he likes to buy it when it's 1 or below, but that obviously hasn't happened very often in the last 20 years. Last time that happened was actually 0809, but he would see a market like this as relatively expensive, at least based on his investment philosophy.
Got it. Cool.
So we also see stock trading with very high enterprise value sales ratio. Basically, we've seen the most type of trading since basically the tech bubble, as far as that goes. Also, the non-profitable tech stock index was very profitable. So if you bought the non-profitable tech stock index in 2020, that was essentially a 4x, and just a dramatic increase there.
Is this safe to say we're seeing the profits of Robinhood traders literally right in front of our eyes?
Yeah, that would be a fair assessment. So to say, well, you know, I think this market's overvalued and I'm going to short it and I'm going to take these positions against it. Today is a classic lesson in why that's not always a good idea. So before today, I don't know exactly what it is today after the short squeeze that we've seen, GameStop actually had more shares that were short as a percentage of their float than the total amount of float out there. That can happen if people borrow and leverage.
So real quick, to make sure I understand, there are more shares that are being borrowed than there are actually total shares, or is it the combination of the borrowed shares and the total shares is greater?
No, this is literally the amount of borrowed shares. So think of it.
Borrowed shares.
Think of shorting very simply, right? You go into your broker and you say, I want to borrow the stock that I don't own. You later sell it with the promise that at some point you're going to have to buy it back, right? Yeah. Here's the thing a lot of people don't realize. The broker, under extreme market conditions, can actually force you to buy back. And that normally will happen at the worst of times, like we've seen today. So Andrew Left, he's a famous LA short seller. I've actually seen him in a couple of conferences in the past. And he runs this firm and now a hedge fund, Citron Research. So he's gone into war with Robinhood traders and forums and Twitters over the last couple of days when he posted a video basically presenting his bearish thesis on GameStop. And you could literally see one of these forums here, just bought more, let's go, keep buying, buy it. Guys, please hold, got to pay my student loans. So all these Robinhood traders essentially just decided to gang up on him, knowing that he has a giant short position, which is one of the reasons that he posted later on that what they experienced over the last 48 hours was shameful and sad. And essentially they decided that they will no longer comment on this. And they're hoping there will be government enforcement. That's probably what somebody that lost $1 billion would say.
Oof.
Which resulted in unprecedented move in GameStop. This was actually before today. It went to all-time highs. The stock literally goes from $5 to $150 in a matter of days. So when you understand why these moves happen, this is why it happens. 150% of all the float is held short. And the margin call comes, the broker says you have to buy it at any price. You hit the buy button at market, but there's nobody selling. So the market literally melts up. Think of it as an upside crash.
Makes sense.
call and basically option interest was extreme. And what we've seen today is that it didn't even hit GameStop alone. It started spreading into other heavily shorted stocks as some of these hedge funds, not only Citron, that were holding these kind of positions, started getting really, really hit during the day. So at 10:40, that's when GameStop actually peaked. So one of the reasons we know that there were hedge funds across the entire hedge fund space was because the entire S&P, for no reason at all of a sudden drops 60 points. And the main reason is, think of it this way: if you're getting a margin call, you have to liquidate whatever you can, not just necessarily that stock. And a lot of it has to do with the market itself. So that creates a break in the S&P itself, and that coincides with the exact top in GameSpot.
Cool. Itai, do you want to just pause? Are there any questions so far, everybody?
If I'm understanding this correctly, this is literally like a real life episode of Billions, where basically an angry mob is learning how to short squeeze like hedge fund managers, and it's like actually working, and they're causing people to lose billions of dollars. Is that correct?
This is literally what happened over the last like Friday through Monday.
Wow. Okay.
It's pretty epic. And it gets even more epic where 0.72 and Citadel literally bailed out Melvin Capital with a $2.75 billion loan today, as they lost 30% in 2021 because they were so exposed to these shorts, and they decided they were worth bailing out. Here's the performance of the 11 most shorted stocks in the Russell. So pretty wild.
Got it.
But there's somebody who made a lot of money today. So Michael Berry, made famous for The Big Short, went big long when he had millions of shares that he bought 2 quarters ago in GameStop. I'm not sure exactly what his thesis was. And we don't know exactly what he did in the last quarter because there's no 13F filing for that yet. My guess is he may have bought even more, so we don't know. But what we do know is he held a substantial position and profited with hundreds of millions, if not close to $1 billion. So he did it again, this time on the long side.
So we just basically moved money from Andrew Left's pocket right to his.
And a few Robinhood traders. So financial market is becoming...
By the way. These were Redditors who did it.
What I heard is that financial markets are becoming a little bit less Warren Buffett and a little bit more Steve Wynn.
Anybody who doesn't know Steve Wynn, you can just hop on Wikipedia. You'll get some info.
That's terrifying.
So if anybody wants some good ideas on what's shorted out there, I provided a list of the most shorted stocks in the stock market as of today.
And where has Tesla been on this list over the course of most of this year?
I don't think there are any shorts left that haven't committed suicide yet, have they?
Okay. All right, that's fair. So basically what we're saying is this big upside crash that everybody saw, and we've talked about on this call before, you know, those people who were short, they all lost their shirts.
Right. So that's kind of some commentary on this. So before we dive into the US dollar, this is, by the way, the performance this past year of the most shorted positions. So before we jumped into the US dollar, I just wanted to stop right there and see if there are any questions about this.
I was going to say, if somebody wants to see the amount of float that's outstanding on a given stock, or if they want to see this information in real time, where can they go to get that?
So if you don't have access to the Bloomberg terminal, that's a little bit difficult. There are a few third parties that provide that research, but essentially just Google SI or short interest and kind of follow. There are a few services out there. I use the Bloomberg, so I'm not fully familiar.
Cool. Everybody else, other questions coming through? Okay, Itai, I guess everybody wants to hear about the US dollar. This is going to be wild, and very, very difficult thing for your brain to process late at night, but we're going to try to get it done. It's very worth it.
Okay. So Janet Yellen said very recently, actually, she just had her hearing and the Senate just approved her as, I think she's not just the first female Fed president, but probably the first female Treasury Secretary. She said that the United States doesn't seek a weaker currency to gain competitive advantage. We should oppose attempts by other countries to do so. And I find that to be quite interesting. So in other comments that she made, she said that even though we have a lot of debt, we shouldn't worry too much about it because the interest rates to pay that debt have never been lower, which is pretty much right about. She also said that we have a $21 trillion debt, which is actually closer to $28 trillion debt, but forget 7 trillion, it's not a big deal.
Between friends, no biggie.
No big deal. So let's assume that we did want a weaker currency. How would we go about it? We would probably cut interest rates. We'd probably engage in quantitative easing and increase the balance sheet. We'd probably say interest rates are going to stay low and forever. We'd probably say we will ignore inflation when it comes and we're going to let it run hot and we're not going to raise interest rate, which, by the way, they did in Jackson Hole last year when the Fed said that they may be accepting higher inflation for a longer period of time. And they would encourage in more fiscal stimulus. So fiscal stimulus is something like the $1.9 trillion that Joe Biden said they will pass. All these things impact the currency. But we are not the only currency in the world. And if we were, that would be, we would probably incur a much bigger currency depreciation. So all these countries engage in some kind of currency debasement. So China, for example, has a currency peg. The yuan doesn't float, and they can just directly control that currency peg. Bank of Japan, the EU, and the SNB, the Swiss National Bank, they engage in both negative rates and quantitative easing. Now, the SNB defends its franc directly via ceiling. I remember there was a time in 2014 where a lot of people got hurt where that currency ceiling broke for a little bit. But essentially, imagine you're Switzerland, you have a lot of exports, all your watches and your chocolate. So you want to make sure that your Swiss franc doesn't get too expensive and that people in Europe, which is your main trade partner, can still buy your currency, right?
So the way that it works though is if the exchange rate gets higher than say a certain level, they just keep buying the other currency to then even it out.
And they will print francs out of thin air to do so.
Okay, got it. That's their ceiling.
Correct. And unlike those, the Fed uses quantitative easing and low rates, but the US has a very loose fiscal policy. So for example, the ECB is more aggressive on the printing and negative rates, but their fiscal policy is tighter because Germany is very opposed to loose fiscal policy.
And real quick, Itai, do you just want to hit people on the difference between fiscal and monetary policy real quick, just so it's in their head?
Yeah, so think about it this way. Monetary policy is controlled by a central bank, where fiscal policy is controlled by the government.
Cool.
More like money supply versus government spending. So let's talk real quick about the dollar performance in the last year. We talked about it in our little quiz in the last call.
Do you want to blow this up a little bit so people can see?
Yep. So we talked about it a little bit in the last call, and a lot of people were surprised that the US dollar actually performed very well during the crash in March, where literally every asset class, whether it was gold, whether it was Bitcoin, whether it was stocks, it was actually down during this period, but the US dollar was up. So what's the deal with that, and why does that happen? So before we can answer that question, let's talk real quick about what happened before the Bretton Woods system. And by the way, we have a call about that. If anybody's interested, they can hit me or Jeremy up afterwards, and we'll be happy to share the call that talks about prior to Bretton Woods system and about the gold standard. So basically, since since the end of World War II, around 1944 is actually where the Bretton Woods system started, and the US dollar was convertible with gold. And in 1971, that essentially ended. And ever since, the gold reserves the US has essentially stayed flat. Well, they say they're flat, but there's never been an actual audit of it. So some people have some conspiracy theories about that, but I won't get into that. So why did Bretton Woods end? So again, the US had a certain amount of gold, but its liabilities started dramatically increasing given the amount of gold that it had. And as a result of that, other countries basically demanded their convertibility of the dollar reserve they had with gold, which created a big drawdown for the reserves. Especially here in the Vietnam War, the US just basically took advantage of it and issued a lot of dollars that they didn't really have the gold to back it down. And it forced the US to abandon the gold standard. So, what's that?
I said, okay.
So basically, there's a very short period of time until 1974 where we're essentially since then in the petrodollar system. And for anybody who wants to know a little bit more about that, there's a secret agreement that happened between the US and Saudi Arabia in 1974. Bloomberg has a pretty interesting article about that. But that was the beginning of the petrodollar system, where all the oil that Saudi Arabia had, and later on other commodities, OPEC, etc., were to be sold in US dollars. So the easiest way to illustrate it is the US is 11% of global trade, 24% of global GDP, but it's 40 to 60% of, like the USD is actually 40 to 60% of all global economic activity. So you can see here as a global payment currency, it's about 40%, international loans almost 60%, and about 70% of all foreign exchange reserves.
So this petrodollar system really ensures that there's always a global demand for US dollars. And as a result, that really shapes the world around us.
Yes, that's exactly what that is. And let's talk about that a little bit. So what's the inherent problem with this petrodollar system? Just very similarly to the Bretton Woods, where they would basically ask for the gold, is that the US actually has to run a deficit, a trade deficit. So not spending deficit, trade deficit, which is a type of the Trifin dilemma that happened during Bretton Woods. So to talk about that really quick is a conflict between short-term domestic. So you want this immediate funding. You want to be able to put in $2 trillion of stimulus and have immediate demand for all that currency. But on the flip side, you're artificially overvaluing your currency because you're creating external demand for that currency, which eventually hurts your exporters. So as a result of that, you're going to run a trade deficit.
And we're always running a trade deficit.
So the idea here is, if you are going to become the global reserve currency, you are going to depress your exporters, and you're going to run a consistent trade deficit that cannot be balanced. And here in 1974, where the petrodollar system begins, essentially that predictions becomes true, and the trade deficit never gets paid off and just accelerates over time. So let's talk about the long-term problems with this kind of system. So what's happening, because you're running a trade deficit over a long period of time, is that you're effectively losing your exporting industries. So everything that you had, manufacturing, you had things that were exporting stuff that other countries could replace or do, is gone. So instead of having other countries give their dollar and we're giving them gold in return, we've basically given them in return the domestic manufacturing base.
Can you give an example of why that happens? Maybe a micro example to like help understand how that trend extrapolates over time?
Yeah, so think of it that because there's demand for your currency, what's going to happen is your currency is going to be overvalued, given if it was only a domestic currency.
Correct.
And as a result of that, if you are a company, let's say you're Ford, and you're selling cars in France. Okay, so
Yes.
in that time it was francs. Now it's the euro, but it would be the same idea. So if there's demand for this currency in around the world, then your dollar is going to be artificially more valued.
So you can buy more.
So actually, in
or
France, you can buy less Fords than you would otherwise. So instead of buying Fords, they're going to be buying Citroen. And as a result, that's going to create a trade deficit between the US and France over a long period of time.
Got it. So they're buying fewer of our stuff because our dollar is stronger. We are buying more of their stuff because it's relatively cheaper. And that cycle continues on perpetuating as we go.
Perpetuating as we go. So when it happens in other countries that are not a global reserve currency, like when they do it over a long period of time. So imagine this happens in the UK, and over a long period of time, the UK runs a trade deficit. What's going to happen to a country that runs a trade deficit is that their currency will eventually get devalued because of that long-term trade deficit, right? So what happens as a result, and why does that get devalued? It basically gets devalued because over a long period of time, if they're running a trade deficit, then they're going to buy this other currency that they're using to trade, and that's going to create less demand for their currency, which will eventually devalue their currency.
And then once their currency, if they're free floating, once their currencies become devalued, now
their exports are more competitive.
Exactly. So you're basically saying everybody else that's free floating is always kind of in an equilibrium. But the United States, because they now have this constant demand from the world in terms of USDs under the petrodollar system, is always going to run a trade deficit. We will never, ever,
Correct. So this is exactly the dilemma. This is what that paradox means. If you are the reserve currency of the world, you are in fact going to run this perpetual trade deficit, and you can't reach that equilibrium the way other countries would. So the way the petrodollar system actually works, it incentivizes the different trade partners that you have to maximize their exports against you. So in this case, the US is incentivizing other countries to max their exports against the US by manipulating their currencies as much as possible. This is, for example, what China does. They're manipulating the yuan as much as possible, knowing that they're going to run this trade deficits with the US. But because currencies around the world are basically fiat that are floating, other countries will keep it as weak as possible and extend the positive trade deficits they have as much as they can. So that allows them to build industrial production. And because they're running a positive trade deficit, they build dollar reserves over time. But the US can't do any of that because it is their global reserve currency.
Got it.
So if I'm understanding this, you're basically saying that like countries are literally arbitraging currencies to basically invest in and accelerate their economic expansion, right? Or
they're not really arbitraging. They are purposely depreciating their currency, knowing that the US doesn't have a choice but to float it, essentially, which is what, when you're talking about like quote unquote currency manipulators, this is essentially what they do, because they know that there's going to be, they know that this will allow them to essentially build their own internal economy faster.
Well, right. So, okay.
Itai, I forget if it's now or later, but can you talk, is it the appropriate time to talk about how that cuts down like an industrial production or manufacturing competency for a country, like let's say like the United States?
Yeah, so this actually leads us to this. So the petrodollar system is probably why what you're talking about has happened. So if you're working in so-called knowledge industry, you are less impacted by this. But as other countries, as a result of that trade deficit, build up their industrial production, their exports are much more competitive than American exports, will eventually, companies with incentives will move away and would basically cut down US manufacturing and move it abroad. This is literally why that happens.
Got it. Okay.
And you can actually see that since 1971 to 74, which is when gold standard was dropped and the petrodollar was adopted, compensation has adjusted for inflation has stayed pretty much flat after both of these have gone up together, and productivity has increased significantly. I suspect that that's the reason.
Okay, so you're saying that compensation hasn't gone up because now they've got to compete against all these other people in the world. They can't. If you're in the manufacturing space, you literally can't allow that compensation barrier to keep going higher.
That's exactly right.
Okay.
Now you're competing against the world.
You're competing against the world because they've now taken all the manufacturing, built it internally because they know that we're going to eat up their exports.
Right, but at the end of the day, it exaggerated the wealth gap. So richer people have gotten richer in this country as a result of that too.
Because and this is probably why the Midwest has taken such a deep dive, and you didn't, maybe didn't understand that, that this was happening in the background.
Yeah. So you also see that when you're looking at the median income. Well, in this case, it's male income versus the real GDP per capita. This is also why that's happening. And again, when does this happen? Around 1974, when the petrodollar system starts.
Itai, do you want to pause real quick? We've said a lot of stuff. Okay. I know you guys are all probably having questions. What are you guys all thinking about in the audience?
I just had a quick question. I thought the theory is really interesting on why the wealth gap happens after the gold standard ends. But are we only seeing that wealth gap happening in the U.S., or are we seeing it in countries that aren't, like European countries as well, where that dollar explanation may not actually fit?
Not to the same degree. And okay. You also see in other countries, we're talking about the wealth gap in the U.S. and all this stuff, but it's a fair thing to note that a lot of that wealth created a lot of middle class in emerging economies, and probably brought hundreds of millions of people out of poverty around the world.
Yeah, that's if you look at Piketty's book or whatever, it compares within countries, but if you look across countries, there's actually been a huge rise of a middle class in India and China, et cetera. Yeah.
This is exactly true. So you did see an exaggeration of the wealth gap in the US, but across countries, it actually dropped.
Yeah, okay. Thank you.
Sure.
Thank you for the question. That was a great one. I see some chat going back and forth. Any questions for the rest of the audience? It's a safe place, I promise. Itai will not thrash you. Okay?
There's no such thing as a bad question. Come on, guys. We're all seeking truth here together.
Yes, we are.
It's been looks like it's been 50 years since the gold standard was dropped. So that was in the news. But the theory about petrodollar, was it ever discussed in the meantime, or it's just something that was discovered and made public very recently?
The Bloomberg article was made public in 2016, how that happened with Saudi Arabia. And it's not an official petrodollar thing. This is more or less just the way things have operated since. So I call it the petrodollar system, but it's not like an official, I guess I don't think it's like an officially stated doctrine that exists. Nonetheless, this is what drives it.
Okay, because finally it does make sense, because before, we separated dollar from the gold, and a lot of things kind of hard to explain just by using that statement.
Yeah, so the petrodollar actually explains a lot of stuff that happened since. It also makes sense with the total dollar cycle that we're gonna talk about.
Itai, Ryan actually has a question. Ryan, do you want to ask that publicly, or do you want me to ask it? Okay, he's got no mic. He says, how do we know how much of this wealth gap is caused by the gold standard being dropped versus the petrodollar system if they happened at nearly simultaneous in time?
It's very difficult to know. I would say, yeah, it's a really good question. I think a lot of it has to do more with the gold standard, but the petrodollar, well, the petrodollar created an incentive to create a trade deficit. If you just drop the gold standard and you didn't go into the petrodollar system, it wouldn't necessarily do that. So it's difficult to answer without running really extensive analysis.
And Itai, we're getting calls from the audience to speak up a little bit.
I have a question if I can. Can you guys hear me?
Yeah, hear you well.
Yeah, Andy's, we can.
Okay, sorry if I'm jumping the gun here. Great, just overview of the petrodollar, eliminating the gold standard. I'm wondering if there's any indication in the data that you guys are reviewing that shows that maybe we're going to make another switch as the reserve currency from the USD. And is there anything alluding to what that currency could possibly be? And what would be the ramifications of that if that were to happen?
It's a great question. So I felt like this call would be appropriate to give more of the background into the petrodollar and the USD system and the cycle. The next call in 2 weeks, we're going to talk about that and what potentially is going to happen in the future.
Okay, I'm sorry. I thought I was getting ahead of myself. I just, you're opening it up so beautifully. I thought I'd ask. Thank you so much.
Thank you.
So Itai, is that your way of trying to get more people to come sign in 2 weeks to find out how the whole world burns down at the end?
Maybe that's the play. We do
that's the hook.
Part 1, part 2.
Part 1 and part 2. All right, let's do it.
Okay.
How to hedge yourself for all outcomes.
Exactly. So talking about that wealth gap, we also see here that in the kind of like early to mid 70s is where that actually starts opening up, where the 20th percentile have had no improvement since, median very little, and the top had most the gain in economic productivity. Okay, so let's talk a little bit about the broader bull and bear cycles that happen in the dollar. So we've heard a lot of talk, like you've mentioned, people have said in the past, well, the dollar is going to not be the reserve currency, it's going to crash, et cetera, et cetera. Let me actually make it clear that in the past, the dollar has not lost reserve currency status, stayed petrodollar, and had twice where it dropped 40% or more.
Can you highlight those times where it dropped 40% or more? Maybe zoom in a little bit.
It happened here in the 1980s, mid 80s through early 90s, and again from 01, 02 all the way through 08, 09. And then it kind of rallied again. And now it's, the big drop since COVID looks very, very small on that longer term time scale.
Cool.
So let's talk about the dollar cycle, right? So why does the dollar even fluctuate given what's happening and everything is fiat and everybody's devaluing, right? So there's different shifts in monetary and fiscal policies still in the US and in other countries, and money tends to chase return. So for example, in the 1990s, there was a great boom in Southeast Asia, and there was this massive demand for Thai baht and all these Thailand assets, and that eventually led to the Asian financial crisis, 97, 98. Also, we have to realize that both governments and companies have a lot of debt that is in US dollar. Basically, according to the BIS, I think it's around 13 trillion. And they also have a lot of assets. They have $42 trillion worth of USD assets. So these are things that built over many, many decades of these countries running those trade surpluses against the US. Again, what we talked about from the petrodollar system. So they're running the surplus, and eventually they're building up their USD reserves. And nowadays, the majority of global financing deals also happen in USD, especially in emerging markets.
So again, reiterating the fact that what everybody doesn't see happening is that there is this incredible demand and need at all parts of the world for the US dollar at all times, even people keeping it on their balance sheet so they can pay for USD liabilities in the future.
So I can even tell you, there are a lot of countries out there in Latin America and other countries where the houses are sold in US dollar and the mortgages are in US dollar, even though they're in foreign countries. That's very common.
That makes sense. Cool. We'll get into that too.
So basically, these dollar denominated debts is a constant demand for the US dollar, right? So when a recession happens and trade is down and the global economy is down, everybody has to pay their debts, and those debts are in US dollar. So what happens? Everybody scrambles to sell assets, get US dollar so they can pay that debt back. And that's normally why when markets crash and you go through a recession, the dollar actually goes up. So here in 0809, you could see that the dollar was up. And in March, when everything was crashing, the dollar was up too, because there was a global margin call, and that was in dollars.
So these people then, all of a sudden, the margin calls get triggered. They're forced to sell. They have to get the USD to pay back their debts. It creates a spike in demand in that period of time.
That's exactly right.
Yeah. Okay.
So the petrodollar is a reinforcing cycle, and it takes a lot of things to derail it. So it starts this way. The countries need dollars to buy oil, right? And after decades of being used to buying oil with dollars, international financing also happens in dollars. And now you need dollars in order to pay those debts. So imagine you're Norway and you want to build an offshore rig somewhere off the coast of Norway, and you're doing it with a British bank. Guess in what currency you take the loan to do that? It will be in US dollars. And you're going to pay that with US dollars too. So now at this point, the dollar is not just backed by oil, it's actually backed by all that debt that is in dollars. So it's a very strong reinforcing cycle, and it keeps happening and happening. And what's funny is most of the debt at this point is not owed to the US, even though it's in dollars, it's actually between countries. So, China, that sits on massive dollar reserves because it's a massive exporter, makes a ton of dollar-backed loans to the other developing countries, and Europe and Japan do the same.
So this,
oh
no, please ask.
Yeah, I was going to say someone who I'd love to hear from at some point is Juliana, because Juliana sits in a company that is very much involved in this global petrodollar system. And I feel like she could offer just some interesting perspective, maybe later, not to do a too aggressive a call out, but I just think it's cool because we have people in the community who have different perspectives.
You've got some interesting, Juliana. Feel free to share.
Yeah, that's an aggressive call out. I mean, I don't really participate in the FX hedging or non-hedging for my particular company. I don't believe we hedge it, so yeah, I think it just floats.
Okay.
But I don't have anything else to add on the US dollar side.
If there is a time, feel free to just.
That's an aggressive call.
Yeah, I didn't mean to be too aggressive. I just remember, I'll put it this way. I met with so Juliana's context works at Shell, and I remember meeting with some of the executives in London at Shell. And one of the big things they talked about is there's just, they do actually have like huge trading desks, and they move massive amounts of money through their trading desks. And one of the biggest challenges that they face does relate to currency hedging. It also relates to the fund flows, because they're arbitraging. Like a lot of times in their pumps all around the world, they're ingesting dollars in exchange for, at the retail, in exchange for the petrol. But they're actually able to, on the back end, they don't always want that much dollar exposure on their balance sheet. So they're looking at how do they diversify, but what do they hold? Because it's like the whole business is like ultimately it ends up being denominated in dollars, but it's a global business. And they at least, I don't know. I just remember it being a really interesting conversation. Didn't mean to call you out too aggressively. But.
No. I don't work in the FX trading department.
Okay, so I'm going to take us back here real quick. So Itai, when you're talking about the whole world needs dollars and they need to be able to keep dollars on their balance sheet, this might explain even why when yields are like 1% on a 10-year treasury, why there still might be some type of continuing demand for dollars. Because if you still need them in the future, no matter what, you'd rather get something more than what you have.
That's exactly right. So here is here you can actually see the impact of the US dollar and the emerging economies, which are probably the most impacted, right? So if we look here, you see in the bar chart, that's the emerging market index going back here. I think it's about a 20-year chart. And in green, of course, is the US dollar index versus a basket of currencies. And you can see that the emerging market index advances when the dollar is falling. For the most part, it's an inverse correlation, right? It's very difficult for emerging markets to rally in a strong or flat dollar environment, and they tend to rally when the dollar loosens up.
Itai, are you going to teach us why this is the case? Is that what's happening next?
That's exactly what's happening next.
Yeah.
So why is this happening? So when the dollar gets stronger relative to an emerging market currency, it kind of acts as a quantitative tightening that actually sucks liquidity. And the reason is because the debts are dominated in dollars, and that makes the payment of the loan more difficult. And I'll give you an example in a second.
Yeah, do the example, because if you get too technical here, you're going to lose all of us.
So imagine,
make it fun. Make it fun.
Imagine you're Argentina. Not to say anything bad about Argentina. It's a wonderful country. And Argentina says we're going to take a loan, or one company in Argentina, actually, it's a company, says we're going to take a loan to do some business for $1 million. And $1 million at that time is worth, let's say, 10 million Argentine peso. And everything is good and fine. It's a 10% loan. So you basically have $100,000 payment, which is equivalent to 1 million Argentine peso. Now, the dollar gets stronger, and your currency is devalued by 50% against the dollar. And now the $1 million that you owe is in fact 15 million Argentine peso, not 10 million. So you now need to make a payment equivalent of $150,000, basically 50% more payment, 50% more debt. And that's going to really, really hurt your balance sheet and your profitability.
So let me make sure I understand. Dollar gets stronger. All of a sudden, your currency depreciates. You now have to give more of your currency to get US dollars. And so that forces you to, it's almost quantitative tightening, because it's just sucking more of your currency out of the system.
It is quantitative tightening. And it normally happens when you go through a recession anyway. So that actually makes it even more difficult when you're going through a recession, because your economy is contracting, you're doing less business, and at the same time, the dollar is increasing in value, and all your debts are bigger.
So why don't they just hedge their currency risk from the outset?
Some do, but there's a finite amount to how much you can hedge expiration. And also, even when you do hedge, sometimes you have to pay significant premiums given the risk level of the country. But there are numerous reasons why sometimes you can and can't hedge. But basically, that's essentially the key reason why emerging market economies are more risky than developed market economies. And that's why emerging markets are so volatile. It's the debt cycle that's denominated in dollars.
Can we talk about a situation now where the inverse happens, where you have a depreciating dollar, and how it helps spike all this activity in these emerging markets?
Yeah, that's exactly right. So the opposite is true, and a weaker dollar is a type of quantitative easing for emerging markets. So you took loans in dollars. The same example, you took $1 million loan, that's 10 million Argentine peso. Now the Argentine peso is worth 5 million to $1 million. So in effect, your monthly payment just dropped 50%. Your debt dropped 50%. You're looking great. The economy is booming. You have more profits, and there's more prosperity to go around.
Got it. So then they're taking more loans, they're making more investments. It's the good times. And that's why you see a depreciating dollar go along with the rise in emerging markets.
Right. So basically, during a weak dollar period, you normally would see some type of economic boom that has happened in the past already 2 or 3 different times. And the United States will also have a period of growth, because at the end of the day, the United States is primarily an import economy, where it's over 70% of the US economy is consumption. So if nations are smart, what they normally do during these times is they build up their FX reserve in dollars, because remember, they're running a trade surplus to the US dollar, which results in excess US dollar reserve in those countries. So what they do with that money is normally they save it. And the way they save it is they buy treasury securities in the US, which creates a constant forward demand for US treasury securities, right? Because you're not going to hold it in cash, you're going to put it in US treasuries.
Correct. Okay, that was a lot. Itai, do you want to open it up to questions just for a second?
Sure.
A quiet Rob Ross. Haven't heard anything from that guy today. I'm worried about him. Okay.
Rob, are you alive? What's going on?
For all of you that don't know, Rob is usually one of our most active participants. So
there are two of them. They must be competing against each other.
Rob Ross's, he doubled?
He might be just logged in twice. He might be having, yeah, he's got a life too. Being here to participate isn't his only thing.
Maybe Rob was shorting GameStop.
I hope not.
He's got computer issues. He's been mining too much Bitcoin, and yeah, he's just taking up all his RAM, you know?
Okay. So basically, I'll continue. So you can actually see that correlation really, really well, where the amount of US treasuries that foreigners hold is fairly inversely correlated to the dollar index for that reason, right? They're building their dollar reserves, they hold it in treasuries, et cetera, et cetera. So when the dollar rises, they usually draw down on that amount to pay the debts. And when the dollar falls, they build up those reserves. That's what's happened in the past.
This is great stuff, Itai. This is awesome.
Okay, so how does this dollar cycle turn? Which leads us to more or less where we are today, right? So we've had these three massive dollar bull runs that basically ended up being a reduction of the amount of treasury securities held by foreigners. But the US still issues debt, right? But just foreigners aren't buying it. So it creates a situation, if the dollar is strong, the US issues those debts and the Fed buys it in the form of quantitative easing. So eventually, if the dollar gets too strong, the US policy becomes really, really dovish, which we see with even what Jay Powell did, Janet Yellen, and what we talked about in the beginning. And then the dollar starts weakening again. And in the past, that has resulted in a time of economic boom. And now we're seeing it with an unprecedented amount of QE. So this is another example that you can see that corporate profits have been fairly correlated to that dollar cycle too, where periods of very strong dollar see limited growth in profits. And then periods of falling dollar have had a much easier time for profits to accelerate.
So it looks like there's a ton of pressure to really depreciate the value of the dollar for a lot of people's interests.
Yeah, I was just about to ask, who doesn't want to have?
Oh boy.
Well, but on the flip side, remember that there's still demand for it with other countries and other debts, and it's technically creating more social inequality within the US and creating some problems within the US as well. So there are winners and losers to the petrodollar, and that's kind of the end of part one. I leave you all with suspense, because what's happening is, what I didn't talk about is that every time we have one of these dollar cycle tops, we're coming out the other way with a lot more debt. And how sustainable is that going to be in the long run? So that's something we'll continue in 2 weeks.
Wonderful. Can we all give Itai a virtual round of applause for his awesome, awesome work there? And now,
thank you, Itai.
Yeah. It's all open for questions. Everybody, barrage this man. He has nothing else to do tonight.
Hi, guys.
Yoni, how's it going?
Good. Sorry I was muted and hidden for most of the call, but yeah, really fantastic. I'm so happy that you're covering pretty much everything we discussed when we spoke a few weeks ago. And so I'm just looking forward to the next call, like everyone else, I think. But a couple of questions, somewhat related. First of all, when the markets crashed at the start of COVID, there was, a sharp rebound. And then that wasn't really just like, it wasn't really just a bounce, like it continued, right? Even till now. And so where was all this buying coming from that was so confident and so sustained, such that it wasn't just like a dead cat bounce, And I had this conversation with a friend of mine who has other friends that work in, New York, in New York financing. And I said to him, do you think the government is buying stocks? Which is kind of like a scary thing to say because they're not supposed to do that. And he said it's interesting because one of his friends said that there are whispers that he's heard that there are kind of like shadow companies run by the government that are buying stocks. I mean, it sounds pretty conspiracy oriented, but what are your guys' take on the government potentially propping up the stock market in that way? And then I have another question about
let's do one question.
Let's start there, and
the next one, let's just go right to the question. Okay.
Yeah. So it's a little unrelated to the whole dollar thing, but we have shown in prior calls that we talked about it. I think around May, when this was kind of starting out, there's a really strong correlation between the Fed balance sheet and what the S&P 500 does. And you don't necessarily need to directly buy stocks, because if you suppress the yield curve by basically having 0% bonds, there's no point in putting money in bonds, right? For even for corporates and stuff like that. And then on the other end, you are, so you suppress the bond yield and you're producing a ton more new money that ends up in accounts. You're essentially forcing people to buy stock because otherwise there's no yield, right? So you don't necessarily need to directly buy stock in order to create a lot of demand for stocks, if that's kind of answers your question.
So is the ultimate answer buying real estate?
Yeah, it's Central Texas multifamily real estate within a few hours of where Itai and Jeremy live, of course.
No, but in seriousness, you've got, hasn't real estate been a very good hedge against inflation?
Historically, yes.
But I mean, I guess what I'm saying is you have three pools of, let's say, buyers, right? You have retail buyers who, I guess, as we saw today with GameStop, can make a difference or make an impact. But I would say we could probably put retail traders aside. And then you have institutional buyers and then potentially the government, right? Which we can even put them aside. So in the institutions, you have either these hedge fund managers or institutions who are human beings making decisions, and there has to be some kind of confidence and reporting to kind of get people on board with that as human beings. But you also have the algorithms, the black box, computer programmatic trading that we've also seen in the past create big market moves. How would you allocate what happened? What I'm saying is, are we living in a world where computers are making these trades, people just take their hands off the wheel and say, I don't know? Or are there individual humans that have this much confidence in the market to drive it to these levels and continue buying?
Well, think about it this way, right? There's also the phenomena you haven't talked about, which is the rise of passive investing, which right now there's more passive funds than there are active funds. That actually just happened in the last year or so. So like the vanguarding, indexing, and all that stuff is a really big phenomenon. And you also didn't necessarily mention that they've literally created 28% last year of M2 money supply. So there's just $7 trillion of new money that is just created. So you would get a different price if, for example, you take the price of gold and divide it by the price of the S&P, which is something you can do over 100 years plus. So you get the idea of how much gold would it take you to buy one share of the S&P to get the more like no inflation answer of where price is versus dollar price. Those are two very different things. If there are more dollars in the world, but the same amount of assets, wouldn't those assets go up in value?
Theoretically, but who's making the decision? Because there are other assets like real estate, like gold. Who's deciding to put that money into stocks? Is it the government doing it in the shadows? Is it hedge fund managers as humans making that decision? Or is it computers that are programmatically doing it because they have more cash and they have to distribute it or apply it?
I think it's a mix. You have some hedge fund managers that realize that a lot of hedge fund managers would, think that you don't fight the Fed because that has not been a good advice to do for years. You have people that invest, you have Vanguard, and sometimes you don't need a lot of buyers to move the markets. Especially last year, we've seen some stuff with SoftBank moving markets massively just because they were buying a ton of derivatives. So I actually looked at the numbers. There was not massive amount of buying that happened, but the market still went up quite a bit.
Cool. Itai, I want to ask a question that came in from somebody that doesn't have good mic access. It says, have you found a statistically significant inverse relationship between the dollar and commodity prices and how much of a lead lag time?
I've seen that there is a inverse correlation between commodities and dollars just because commodities are priced in dollars. But that doesn't take into account actual supply and demand from emerging economies. So there's some relationship to it, but it's not the only outlet. There's actually a very interesting relationship between commodity prices and China's credit impulse, because the amount of credit produced in China relates later to Chinese commodities demand. China is the biggest buyer of commodities in the world.
Got it. And Larry also asked, Larry, do you want to ask it? I don't know if your mic is working today. I don't think it's working, but he said, is there any, under what scenario do we not get inflation with all the money printing?
Yeah, inflation is a difficult things to predict because there are structural headwinds against inflation. One is demographics. We are basically trending below replacement rate in most developed economies. And the other
means
one,
we're having fewer people are having fewer people.
You guys need to get to work.
We'll have another call in the next month or so covering demographics, because I think it is very important to understand now we're talking about our structural view of the world, right? Like the dollar, we're talking about big things like that. And demographics is definitely a part of it, because most Western world has less than 2.1 kids, which is replacement rate. And that's basically deflationary, right? If there's literally less people buying less houses, less cars, etc. The second thing, technology has been very deflationary as well. So think about Amazon for a second. How many jobs did Amazon kill versus create? So those two things are super deflationary. And even though central banks print all this money and do all these things, they're still countering those two very strong structural aspects. So when you ask, how could we not have inflation? That's the reason why. There's structural reasons.
Thank you. Cool. What other things are on your guys' mind?
Well, I was just writing about it, but I'm just wondering if we do get this wealth gap increasing, but with the technology boom we are seeing in terms of everything that scales like Instagram and VR and everything, could that actually lead to a situation that is kind of sustainable and you don't have some uprising?
So are you saying, just because it was a little hard to hear you, are you basically saying, hey, can this new wave of tech basically keep the lower class at bay from a revolt?
Exactly.
I don't know, what does history say?
Ray Dalio just came out this past week and actually warned about a civil war and uprising kind of scenario. I think it's possible. Are you in a place right now that you're benefiting from the dollar's reserve status?
Well, flight of commerce is not a bad place to be.
Got it. Joe, you seem to be thinking in alignment that this wealth gap could be getting us in a position where we need to be ready for things to go south. Is that the case?
You know, it was funny as I was typing that regarding the pitchfork comment, and Itai was commenting on Dalio. It's you spend time in flyover country, and it's pretty easy to see that this theoretical discussion can very, very quickly disintegrate into that.
Yeah, it can. So I guess the point is, the question is when, or what needs to change to potentially keep it from going on to that course.
Right.
But to me, the people who would actually be getting a detriment from this are the people that would be getting like a universal basic income, and they're the ones that want this, even though it would hurt them ultimately. That's what, to me, makes me think this could go on for a long time.
Paul, it is hard to hear you, but it sounded like you were saying that the people that are hurt the most by this are the people receiving UBI. And I didn't necessarily know what the last part of what you had to say was. So maybe you want to type it. I guess being in Playa del Carmen makes it a little more difficult. It's a little more happening.
What's funny to realize now is that you're talking about UBI. Now that we had this call, you're actually understanding that the rest of, if we do a US UBI, the rest of the world is actually paying for it. given the way the petrodollar is structured. So that may be pushing it to the point where the resistance from other countries may be just too great.
Makes sense. Itai, what I'm going to do is, I think this will be the point where we'll let everybody go because it's been about an hour. Everybody else that wants to stay on, we just kind of hang out. We talk about anything. It could be a continuation of the conversation, but we know that a lot of you have lives and things to do. So I'm gonna kind of pause it there.